So these are the different regulatory requirements for valuation. And we are going to talk about valuation for cross-border share transactions between resident and non-resident entities per Foreign Exchange Management Act, FEMA guidelines, and Security Exchange Board. So this is background of FEMA. The Reserve Bank of India, RBI, the custodian of the country's foreign exchange reserves, and is vested with the responsibility of managing their investment. RBI is in consultation with the government regulates the flow of foreign exchange in and out of India and facilitates external trade and payments wise the Foreign Exchange Management Act 1999, FEMA Act. Under FEMA, all transactions involving foreign exchange have been classified either as capital or current account transactions. To ensure that these transactions takes place in fair valuation for prudent usage of foreign exchange, FEMA has various provisions dealing with the valuation requirements while entering in such transactions. The key tenets of FEMA valuation regulations ensures that whenever the foreign exchange is coming into India by way of capital investment, it should come at a value which is not less than the fair value. Similarly, whenever foreign exchange is going out of India by way of capital investment, it should be invested at a value not more than the fair value. So these are the outbound and the inbound transactions which can take place. So the slide is, I think, self-explanatory. So there are some FEMA guidelines. So non-debt instruments means the following instruments, namely all investments in equity instruments in incorporated entities, public, private, listed and unlisted. Capital participation in LLP, all instruments of investment recognized in FDI policy notified from time to time. Investment in units of alternative investment funds, real estate investment trusts and infrastructure investment trusts. The investment in units of mutual funds or exchange traded funds which invest more than 50% in equity. Junior most layer of securitization structure, contribution to trusts and depository receipts issued against equity instruments. So equity instrument means equity shares, fully and mandatory convertible debentures, fully and mandatory convertible preferential shares and shares warrants issued by an Indian company. Thus, FEMA valuation is required to be carried out for any investment in non-debt instrument as listed above by any non-resident or transfer of such investment from non-resident to resident or vice versa. So these are three conditions where these transactions and who can do these valuations has been given. So from FEMA valuation perspective, the valuation report is typically valid for 90 days from the valuation date, that is the cutoff date basis which valuation has been determined. Historically, FEMA recognized discounted cash flow DCF methodology and practically they insisted on the same. However, in particular cases, other methods can be used which are internationally accepted methods by giving appropriate weights to each such method. So coming to SEBI, the Securities Exchange Board of India has issued a set of guidelines to be complied with all by companies listed and proposing to be listed on stock exchange for issue of capital. SEBI plays a crucial role in creating a transparent, fair and efficient security market in India by formulating and enforcing regulations, protecting investor interests and promoting the development of the market infrastructure. One of the SEBI's primary responsibility is to protect the interests of the investor in the securities market. This involves ensuring transparency for fair practices and providing investors with accurate and timely information to make informed investment decisions. SEBI works towards the development and promotion of the securities market in India. It introduces reforms and initiatives to enhance market structure, improve market efficiency, and attract more investors. Thus, it is imperative that the transactions in securities happen at fair value to protect interests of all market participants. Accordingly, SEBI has issued rules and regulations dealing with the valuation of securities that must be adhered to by the listed companies. So these are different scenarios amongst other for valuation. And SEBI has provided valuation mechanism for computing value as per market price case of frequently traded shares for open offer and preferential allotment. This mechanism is based on value weighted average price of the share during the prescribed period, considering weekly highs and lows. So these are different events and how the valuations can be carried out under different SEBI accordance with the in accordance with SEBI guidelines. So these are different valuation methods: income approach, market approach, and cost approach. In discounted cash flow, wherein the relief from royalty, multi-period excess earnings with and without intangible assets. Relief from royalties for royalty saved from when you own the technology. Multi-period is the gains made from interperson relations with the clients with and without are for valuation of intangible in terms of human resources. So these are the appropriateness of valuation methods in various scenarios. So knowledge-based companies, you can have income market, manufacturing business for income, market, and asset. Investment companies, real estate companies on basis of asset, company into liquidation, asset, and listed companies on the basis of income and market. So the challenges. So the main challenges are like selection of the most appropriate method, forecasting and validation of the financial projections. I think this is the most crucial area wherein there can be differences amongst the two valuers. Growth rate and terminal value calculation, type of instrument, equity, preference, debentures, characteristics of the instrument, redeemable, convertible, and regulatory requirements. So this is the general practice being for documentation of valuation and valuation report articulating.